Finances, a word that triggers and confuses most of us med students and physicians to the point where we'd rather ignore them completely and let somebody else deal with them. But I'm here to convince you that ignorance is actually a terrible idea and why taking charge of your finances will actually be incredibly important to the point where it's probably going to save you millions of dollars in your future career. Now, I know that's a bold claim and I will back it up, but before we get to that, I want to go over the topics that we're going to cover today. Now, I'm going to make this nice and simple for you. So we're going to cover 6 main buckets today. The first bucket is going to be everything that's to do with incorporating, taxes, and accounting. The second one is going to be investing and debt. The third one is going to be insurance, which is very important for medical providers. The fourth one is going to be billing. The fifth bucket will be budgeting. And then the sixth bucket will be banking. Now, this will be a complete tutorial, so it means the video is going to be pretty lengthy. So feel free to skip over to whatever sections that you're most interested in and need the most help with. By the way, for those of you who are new to the channel and don't know me, my name is Braden Pearl, and I'm a 4th-year medical student here at McGill University, and I'm the CEO and founder of Advancement Hockey Advising, where we're a hockey agency that helps advance players to the next level. Now, you're probably asking yourself a very valid question at this point. Who is this guy? Why should I listen to him for my financial situation and take any advice from him at all? Now, I'd like to answer that question with 3 main points here. So the first big one is that throughout medical school, the past 5 years, actually, I owned a business, which is a hockey agency that I mentioned earlier. I helped scale it to a 7-figure business. So basically, I learned a thing or two about, accounting, finances, how to manage a business. And I think these skills can really be applied to medical professionals moving forward. So I think that's the biggest thing that I can bring to the table as to why you can listen to me. Second big thing, being a medical student and almost done now, working with countless staff and all these things, I've picked up a few things along the way. And I think a lot of things that I picked up are little tricks on the financial side that could help share with you. And I think it'll really help you guys moving forward here. And then third biggest thing, probably the most important, is I have no conflicts of interest. I have nothing to sell you. I'm literally trying to help all my classmates out and help as many people in the medical sphere as possible to retain their wealth and not get gouged by different financial corporations that don't have your best interest in mind. And last thing here, before we get into all the different buckets that I want to talk about, the biggest thing why this is important, and ties back to what I said in the intro a while ago, is that this will save you a lot of money. A lot of these corporations that say that they're going to manage your wealth, they charge 1 to 2% management fees. So what that means is 1 to 2% of all the assets that you're managing, which is pretty much all your assets whenever they manage this, if you're really ignoring finances and letting them deal with it. Now, that 1 to 2% might not sound like a lot, but it actually is if you break down the numbers, okay? At first, let's say you make, $400,000 your first year of being an attending, and they charge 1 to 2% of that. That's actually not that much. But compounding over time is a legit thing. And if over the years, let's say 10, 15 years down the line, you still have that 1 to 2% management fee, let's say your net worth is $10 million, okay? If 1% of $10 million is being managed, that means they take out $100,000 just for managing and doing a few clicks of the computer that you could easily learn yourself and easily do. So over time, if you keep getting managed like this and keep getting these fees over like 30, 40-year time frame, that is millions of dollars that you're gonna end up losing, that you could actually just learn the skills yourself today through this video here, the basic stuff that they implement, and you can do it yourself and save yourself millions of dollars. I know it seems like a bold claim, but it's actually very, very true, which is why I'm making this video for you guys, to equip you guys with the knowledge and the skills to do it yourselves moving forward. And at the very least, if you're not doing it yourselves, that you actually can ask better questions when you're talking to these portfolio managers. And last quick note here, I am from Canada and I do plan on practicing in Canada. That being said, I do think some of the key principles here in this video do apply to physicians throughout the world. And the key details here, like some of the details won't apply directly for people in different countries, but definitely keep the key principles in mind here throughout the video. All right, so let's start with the first big bucket here, that is incorporating, taxes, and accounting, all lumped into one big bucket. Now, we hear the term incorporation thrown around quite a bit, especially as you become an attending, but what does that actually mean? All it means is that you're separating yourself from your legal business entity into 2 different legal entities, okay? So there's yourself, for me, Braden Pearl, and then there's the, physician holding company of Braden Pearl, which is a totally different legal entity. Now, why would you incorporate? 2 main reasons. One, there's advantages from a legal protection standpoint, from a liability standpoint. And then secondly, there's a lot of tax advantages when it comes to incorporating, which we're gonna get to in like 30 seconds, but there's a few more things that I wanna cover first. So you're probably wondering, when should you incorporate? When should you consider it? Typically, the rule of thumb to follow is $30,000 to $40,000 per year in excess to what you need. If you have like, let's say $100,000 sitting around that you really don't need to spend this year on any expenses or anything like that, usually if you have a big nest egg over $30,000 to $40,000 kind of just sitting around, that's where you kind of want to incorporate to shelter your finances and get some really good tax benefits out of it. Now, if you kind of meet that threshold there, and obviously it's different person to person, but let's say you want to incorporate, how do you go ahead and do that? Well, there's two main things you need. The first thing is you need to find a good corporate lawyer. Really easy to find depending on your area. You really don't need to be that area dependent. It could be somebody in another city as long as they're able to do the documentation for you. So that's one thing. Google search, super easy to find. The cost is around $2,000-ish. It could be a little bit more, a little bit less, but usually that's the market rate for the cost to incorporate, set up the entire process and all that stuff. So usually pretty easy. And it's actually those costs you can actually deduct off your corporation too as a business expense. And we're going to get into what that means a little bit later, but just know those costs can be covered in a tax advantageous way. And it's quite easy to set up and actually doesn't cost you that much in the long run. Second thing you're gonna need to do is find a really good accountant. Now, high yield here. If you're gonna remember one thing from this video is that finding an excellent accountant is the most important thing you can do for your financial situation, okay? A great accountant can really save you a ton of money, way more than what you invest into them. They're gonna save you so much, but they have to be very, very good. Not that easy to find a really good one. Try and ask your friends, colleagues, anyone for a referral from a really good accountant that they have great reviews for. If you find a great accountant, it will save you so much money in the long run. Just trust me on this one. Usually an accountant is going to cost roughly $2,000 to $3,000 per year to manage both your personal and business finances. But to be honest, if you have to get a great one that costs $5,000 per year, it's totally worth it because again, it's deductible off your business. We're going to get into what that means in a bit, but it's totally deductible and they will save you so much money in the long run. So no brainer, high yield. Most important tip of this video here is to find a great accountant for you. All right, so let's dive into the corporation tax advantages here. So there's two main things that are advantageous in terms of taxes to incorporate here. So the first big thing is that there's a lower tax rate for small business corporations. And the second thing is that you can deduct those expenses like I was talking about on your overall tax rate or your overall taxable income. So we'll get into what that means here. So in terms of the corp tax rate, so how it works is any small business, so any business making under $500,000 in net revenue or in profit, let's say, so that's after the expenses are deducted, anything that makes under $500,000, they are taxed at 20% in a corporation. If you compare that to on the personal side, anything, north of like $200,000 is taxed, in Canada, at least between like 50 to 55% or something around those lines between the federal and the provincial. So you're taxed at a much higher rate on the personal side compared to if you keep a lot of money in the corp. Now there is a catch here because you're taxed at a lower rate in the corp. Once you take out money on the personal side, you're also taxed again. So you're double taxed going from corp to personal, okay? So that's one thing to keep in mind. But again, for most people that are making a lot of money that can do the small business corp, it does make more sense to get double taxed than it is to be taxed at a super high rate on the personal side. And we're gonna get into an example in a sec here. The second big thing of a corp, how it's tax advantageous is that you can deduct those expenses, okay, on your total income. So what does that mean? Is any expense that assists you in running your business, okay? So for example, gas to get to the office space rentals. If you have to go to conferences, conferences where they talk about different aspects of medicine, all that stuff in the specialty that you're interested in, the flights to get there, all of these can be deducted, right? Utilities, all this stuff, all of it can really be deducted on your business. Now you have to speak to a really good accountant to see what you can and can't deduct because there are specific rules in place, but there's a lot of gray zone areas too. And speaking to a good accountant can help, deduct as many expenses as possible. Why that's important is because let's say you have $500,000 that you made as a doctor this year. In a corp, or even without a corp, you can do this, but it's a little bit tougher. But in a corp, you can deduct a lot more. So let's say you make $500,000 and your expenses are, let's say $100,000. Well, you're not going to get taxed for $500,000. You're going to get taxed for $400,000. So you're going to be taxed at one, a lower rate in the corp, but two, you're going to be taxed at a lower number overall. So less is going to be taxed. So you're going to end up saving a lot more money if you deduct more expenses. So the best way to explain this is an example. Okay. So let's say you make $400,000 in a given year, okay, as a doctor. And then let's say your expenses are $150,000. Let's say between overhead, between expenses that you claim and all that stuff. That means you have $250,000 left in the corp after expenses that can be taxable. Now, of that $250,000, okay, let's say you take $100,000 salary outside of the corp, okay? That salary is tax deductible on the corp. So the corp leftover net income is $150,000. And then on the personal side, you took out $100,000, okay? Typically, depending on the province, this $100,000 is going to be taxed, between, it's probably going to be $30,000 or $35,000 that you're going to lose to taxes. So you're left over between $65,000 and $70,000 on the personal side. And this corp that is $150,000 left over, that's going to be taxed at 20%. So taxed at 20%, basically you're gonna be taxed $30,000 inside the corp. So overall, you're gonna lose roughly $30,000 of taxes in the corporation, and then $30,000 to $35,000 in taxes on the personal side. So overall, you spent about $65,000-ish dollars in taxes. Okay, so decent amount of taxes, but let's see what happens on the personal side if you choose not to incorporate and not deduct any business expenses. So on the personal side, let's say you make $400,000, and then at that point you deduct $150,000 on the personal side, leaving you with $250,000 on the personal side. Typically, it's going to be harder to deduct that $150,000, by the way, so you probably won't have $250,000 straight away. It might be even more that gets taxed. But let's say all goes well, you deduct all these expenses on the personal side. At that point, $250,000 will be taxed, and you're going to pay roughly $100,000 in taxes. Okay, so if you compare this to on the corp side where you paid like $60,000 to $65,000 versus $100,000, you see right away how you save on tax money on the corporate side, okay? So that's why incorporating and being advantageous with taxes makes a lot of sense. Again, speak to an accountant or DM me if you have questions, anything like that, but speak to an accountant as to how you can set this up where it makes sense. And there's other strategies you can put in place too on the corporate side where you can end up maximizing tax money that you save so you can keep more money in your pockets. One rule of thumb that I want you to follow is usually what's most beneficial to transfer money from corp to personal is under $100,000. Obviously, there's registered accounts that we're going to get into that you can account for and all that stuff, but registered accounts aside and other tax saving strategies aside, under $100,000 on the personal side is usually what's most advantageous in terms of taxes. Anything you would draw more than that and that doesn't get shielded tax-wise is going to be taxed at quite a high rate and won't be as advantageous anymore. So you're probably asking yourself, how do I even keep track of all this? What platform do I use? Like, how do I even do all of this accounting and all that stuff so I stay organized? The platform I use for my business is QuickBooks. Super, super useful. Honestly, it's really cheap. Keeps everything integrated nicely, keeps track of all my expenses through my credit cards. It links all your bank accounts and all that stuff. And all I have to do whenever I buy something or an expense that I put on the business, I keep the receipt, take a picture of it with the QuickBooks app, and it integrates really, really nicely. So one, this is nice because it's going to reduce your accounting costs. Okay, it helps your accountant a ton and they waste a lot less time working on your stuff. But secondly, super important in case you ever do get audited, that you're super organized this way. The accountant can kind of just take over and take care of everything. So really, really important to keep track of your stuff well. I'd recommend QuickBooks. We're not sponsored by them, don't worry. It's just the one that I've used and that I've liked. Now I want to touch on quickly how you can pay yourself from your corp. There's usually two main ways here that you can do it. In Canada, it's different than other countries in terms of the advantages and all that stuff, but the principles stay the same. So there's two main ways, salary or dividends, okay? So what salary is pretty much is that it's actually tax deductible off the corp. So what we mentioned a while ago, let's say you have a $250,000 net income and then you pay yourself a salary. Well, let's say it's $100K. It's only going to be $150K that's going to be taxable in the corp. So it's deducted. It's like a business expense almost that you're paying yourself to the personal side. The caveat to salary is that you're taxed at a higher rate on the personal side, okay? And in Canada, they made it a point to make sure that salary versus dividends, there's not huge advantages between the two. It's just about structuring it the right way. Now, dividends, on the other hand, they are not tax deductible on the corp, okay? So if you pay yourself from the corp through dividends, let's say it's $250,000, if you pay yourself $100,000 in dividends, that is not tax deductible. So it means in the corp, you're going to be taxed at the rate, 20% rate at the $250,000. So you're going to be taxed more in the corp. However, on the personal side, you won't be taxed as much on the dividends, okay? So again, with a good accountant, you figure out, okay, what am I going to take out as salary this year and what am I going to take out as dividends? And that way you can kind of structure a plan where you save as much tax money as possible. There's formulas out there. There's a good resource that I use. It's called Cloud Tax pretty much. You just kind of go on there on the computer, and I'll share the link down in the description below, but you can kind of play around with the numbers and see what's going to actually end up saving you the most money in that specific year for you. And one last quick thing I want to mention on taxes and incorporating and all that stuff is insurance. Now we're going to dive into and do a deep dive on insurance in a little bit here further throughout the video, but overall in terms of like just tax saving, tax strategy, insurance is actually a key player for medical providers especially. One, your insurance premiums are actually tax deductible, so that's one big thing inside the corp. So again, deducts on taxes. But the second big thing is certain policies, you can actually, as you contribute to it, build an asset that you can take out from corp to personal tax-free in the future, okay? So for multiple reasons, insurance is a great idea for medical providers, let alone just the liability aspect and the disability insurance and all that stuff. Yes, that part's important too, but from a tax advantage standpoint, very, very useful, honestly, and we're gonna dive into that later on in the video. All right, that's it for the first big bucket. Let's dive into the second big bucket here, which is investing and debt management. Now, a lot of you are probably wondering, why don't I just save the cash? Why do I even bother with investing? Why do I even bother with the risk of potentially losing money? Well, the reason is inflation, right? So if you just save in cash, you're actually losing money every year. How inflation works is it slowly eats away at the value of your currency that you're holding in, okay? So usually 2% to 3% is the average for inflation in Canada, and it's the average for a lot of countries, honestly, the first world countries. What that means is that your $100 that you own, after a year, it's worth $98 in purchasing power, okay? So your purchasing power, what your money is worth less and less every year because we are printing money from a societal standpoint, okay? You don't need to get into the weeds of this. Just know that if you hold in cash and if you don't invest, if you don't outcompete inflation, your money is losing value over time. So with that said, now we're gonna get into the deep dive with investments here and the main principles that I want you to keep in mind. Now, this brings me to the first main principle I want you guys to keep in mind here. I think this applies more to medical students and residents that have a large debt burden, and that is to focus on paying off your debts first over investing. Usually it trumps it. Now, there are exceptions in these cases, okay? If you are very savvy financially and you notice that your line of credit interest rate from the bank is very, very low, okay, and then you notice that there's really good trends in the markets and you believe the market's going to continue going in the right direction, which none of us really know, but some people that are savvy financially do have these beliefs and theses in mind. So at that point, you could decide to take out some money from your line of credit, put in the stock market and kind of make gains from there and then repay your line of credit in the future. Or some people even choose to invest and ignore their line of credit and just outcompete the interest that they're losing, basically the money that they're losing with the money that they're gaining in the stock market and the investments that they're making. You can do that. Some advanced people do that, but in most cases, if you're new to this, you're a beginner with finances, you're not that savvy financially, I would say focus on paying off that debt first and then investing into different asset classes. That's the main principle I want most of you to keep in mind here. All right, and now this moves on to the second main principle I want to cover here in investing, and it's what I deem or what I coin the investing return on investment scale, okay? The reason why I want to highlight this is because I find a lot of finance videos out there, very few ever cover this specific topic or have talked about this kind of scale and to how you get rewards basically for the investment of your time or your resources. So I want to cover this right now. So in order from most useful to least useful, number one, the best thing you can invest in is knowledge and skill acquisition of yourself. Whatever you can learn, whatever skills you can adopt and get better at, that is the number one best return on investment every time. Time and time again, this is proven to be true. Number two is relationships. Oftentimes you hear the saying, it's not what you know, it's who you know. Relationships can really, really change the game when it comes to, any investments that you make, any financial deals that you make, any knowledge that you want to learn. Relationships is huge. So I value, knowledge and skill acquisition first, but usually relationships is really close second thing. So investing in people, investing in building relationships, even investing money, time in this, very, very important. It will pay off in dividends in the future. Number three, assets that buy back your time, okay? So not typical like passive income investing and all that stuff. What I'm talking about is anything that can kind of buy back your time. So anything that you need to pay for automating things, for delegating, sometimes hiring people, right? In my business, I've hired a bunch of people. I've automated a bunch of different processes. Anything that can build a system that's gonna save your time, all that stuff, very, very big return on investment, even more so than, investing in all the different asset classes that we're going to talk about here. Fourth, now moving on to investing in things that generate passive income, right? We're going to go over all the asset classes in a little sec here, but overall, and anything that can kind of generate passive income that you don't have to actively worry about, those are nice investments to have. But again, the things before are more valuable in my mind. And then fifth, last but not least, are liabilities. So those are the things that you spend on, more for fun. You're not getting a big return on investment for it, but it can be a fun experience. It could be something like a nice new car that you want to buy, or a mattress that you want to buy that's going to make you sleep very well, or whatever. Any other fun thing, going out with friends, all that stuff. You can invest in those, but just know they are liabilities and they're not going to give you a good probably return on investment of your time or your finances or anything like that. All right, moving on to main principle number 3 of investing, and is to consistently invest in diversified asset classes. So that means do not try and time the market, just consistently invest in a diversified portfolio. Now there's a lot of different asset classes out there, but we're going to cover the main ones. So we're going to go over stocks, bonds, ETFs, index funds, mutual funds, real estate, angel investing, options trading, and crypto. Okay, those are the main ones. There's others that exist out there, but those are the main buckets that I could kind of see. So let's start with individual stocks and bonds. So first, what are stocks? What a stock is a small piece of a company, basically. It's a small percentage ownership piece of a company. There's 2 types of stocks. There's some that are growth stocks. So it's stocks that are optimized for a company that's growing, where you expect when you buy them at a certain rate that they're going to grow to a different rate and you're going to get more value out of it when you buy it. And then there's dividend type stocks. So these stocks are more the type that basically stay the same. They don't really grow that much. They don't fluctuate that much, but they pay out dividends, every quarter or every month or whatever it is. But they pay you out, let's say $100 a month or something like that on a consistent time basis, depending on how much stock that you own. And then you have bonds. So bonds are basically a loan that you give to a company or a government at a set interest rate. So basically it's at some point in time, whatever that interest rate is, they're going to pay you back that interest rate after that set of time expires, pretty much. So that's what a bond is. Honestly, it's very, very stable. It's not as volatile as stocks. Stocks can be quite volatile, but because it's more stable, there's less, return on investment at that point with bonds typically. So the next big asset class that I'm going to lump these 3 into here is the ETFs, the index funds, and then the mutual funds, okay? So basically what these are like a collection of slices of different companies. So for example, the S&P 500 is the top 500 companies, basically all in a nice diversified portfolio at different percentages based on the strength and the size of the company, that a group like Vanguard, for example, manages that portfolio, okay? So that's the basis of it. It's already a diversified portfolio that you're investing into. You're investing in a slice of all these different companies, pretty much. Now, ETFs and index funds, they are managed passively, so there's lower fees associated with them, whereas mutual funds are managed more actively, so there's higher fees associated with them. They all typically give returns between 7 to 12% every year. However, it varies a lot with the risk that you take, so how high risk they are versus how low risk they are. If they're managed actively versus passively, those make differences. What I tell people is I usually put bulk of my money in the ETFs and the index funds, some in mutual funds. I like to diversify a little bit of everywhere and then kind of go forward from there. And then I go to individual stocks a little bit less and then go forward from there. Now you're probably asking yourself, how do I even go about doing this? How do I start investing? In Canada specifically, the best app that I can recommend is Wealthsimple. They have 0% commissions. They barely charge you any commissions on anything. There's a few little things that they charge, but overall it's a really streamlined app, very easy to use. I definitely recommend Wealthsimple to anyone in Canada. In the US, there's some good ones out there too that are similar to Wealthsimple. I'm not going to give a specific recommendation. I am not sponsored by Wealthsimple. I am not giving a link. It's just the one that I found that's easy to use that I would recommend to people. Next big asset class is real estate and REITs. Honestly, so for real estate itself, so I think it's a great asset class to preserve wealth. And for those that are very savvy, it can be a phenomenal way to get tax bonuses and advantages and all that stuff. But for the average investor, if you're new, you're a beginner, I would not dive straight into real estate right away, okay? I'd stick to more of the things that we talked about before because it's a little bit easier. Be wary with real estate, but it can have significant upside if you know what you're doing. 2 main useful advantages with real estate here. So the first one that's probably a bit more simple is house hacking. So the concept here is that you buy either like a duplex duplex, a triplex, or even a 4-space unit. And basically you get a mortgage on this, and then you live in one of the units, and then you rent out the other units to other people with the goal of either covering your mortgage or even exceeding the amount that your mortgage is worth every month. So you're getting recurring revenue, and you can basically, live in a house for free in a way is what they call it. So honestly, it's a good strategy if you have a little bit extra time on your hands, you don't mind dealing with tenants and other people living beside you. So that's one good strategy that a lot of Canadians and people throughout the world have used. Second big strategy is seller financing. This is quite complicated. Definitely have a great accountant working with you if you do this to see if it's worth it or not. But if done correctly, it can be a very, very powerful strategy to save on taxes and gain, further multiply your wealth in the future. That's actually part of my strategy in the future, to build a bunch of medical clinics throughout Canada and maybe throughout the US too. I'm gonna definitely use this strategy. More to be determined in the future if I successfully pull that off or not. All right, let's dive into other asset classes here. So another one is angel investing in businesses. This is where investors with a lot of money decide to invest in certain businesses, early startups that they believe in that require capital, pretty much. I would say this strategy is very high risk, and here you only invest money in businesses you truly, truly believe in, and money that you're willing to lose. So if you don't make a dollar off of this, if you lose all your money, you're completely okay with that money that you've lost. That's the kind of mentality that you have to have with angel investing. Next is options trading. Now there's many different types of options that you can use. A lot of them can be found in the tech startup space, so you can invest in like convertible notes, safes, all this stuff. Very advanced stuff. I wouldn't recommend the average user to do this, but there are different options that you can invest in. It's just very high risk. Definitely speak to an accountant or a financial advisor even before you decide to invest in options. And the last class I want to cover here is crypto. My buddy Omar that helped me script this video here definitely loves crypto, and he's fully into it. And I have a lot of buddies that are fully into it too. My personal take on it, I'm a little bit more risk averse when it comes to this stuff. I think it's a relatively new high risk asset class, but I do see the potential of crypto with the different technologies that it has, especially when it comes to the decentralized system that they promote. I'm a big believer in that. My thesis is that crypto will be more integrated with society as technology continues to advance. So for that reason, I've invested roughly 3 to 5% of my total portfolio into crypto. It's a small amount because it's a very volatile and high risk asset class. If I lose that 3 to 5%, it's fine. It's a small portion of my portfolio. I do see it as high risk, but if it does gain, then I don't want to miss out on it. So I invested a little bit into it. That's my thesis. I know other people that invested like almost their whole net worth into crypto. I wouldn't recommend that to most investors if you don't want to have a panic attack every night. One important principle you have to keep in mind with crypto here is that you must own your keys if you're going to invest into crypto. So there's a common saying that goes, not your keys, not your crypto. The whole point of crypto is that it's decentralized, where you actually own your own asset and you're not giving it to a big corporation like a bank or an investment fund or something like that, that you actually own your keys, you own your wallet, and you own your crypto. That's the whole point of it. For Canadians, the platform I would recommend is Newton. It's a great platform, really easy to use, similar to Wealthsimple. For US people, I don't really know the different platforms, but there's a ton of different options out there in the US. All right, so main principle number 4 that I want to move on to, that we kind of alluded to throughout this investment section of the video here, is that the risk level is proportional to the potential gains that you're going to make. So what I mean by that is, if you look at the ETFs, super safe, low risk investment, but the returns are usually between 7 to 12%. Not bad returns, but very, very, average at best. Whereas if you do angel investing, let's say in a business, well, the potential returns are super high. You could 10x your investment, right, if it's the right business. However, the risk is very high as well. You could lose all your money. There's a good chance that you lose all your money and that the startup doesn't go according to plan. So you just have to know that the more risk that's involved, the higher the potential gains, and the lower risk that's involved, the lower the potential gains. All right, now moving on to the last main principle here in this investing section, and that is principle number 5, that is to maximize your registered accounts. So registered accounts on the personal side, they look in Canada like TFSA, RRSP, FHSA. There's other registered accounts too, but those are the main 3 that I want to talk about today, especially for med students, residents, and new attendings. Now, other countries have similar accounts with similar features, especially in the US, it's quite similarly structured, but overall, these are the accounts for Canadians themselves. One thing I want you to understand before we dive into each of these separate accounts individually is that there are steep penalties if you go over the contribution room. So make sure with your accountant every year, you review that you've properly contributed to the allocated accounts and that you don't over contribute, because you're going to get a pretty steep penalty if you do. So let's start with the tax-free savings account, better known as a TFSA in Canada. In the US, there's a similar account called the Roth IRA. So I love this account personally. It's one of my favorite accounts to invest in, because how it works is that all the money that you put into investments into this account any growth, basically any passive income that you make will not be taxed. Now you compare this to normal investment accounts where if you make passive income, you're taxed at 50% in Canada. In the States or other countries, it might be different, but in Canada, it's 50%, which is quite steep, you know? So let's say you made $50,000 in 1 year in passive income. In the TFSA, you're gonna keep all those gains, whereas in the a normal account, you're gonna lose half of it. So you're gonna lose $25,000 to taxes. So really cool account. Honestly, the more you can maximize that contribution room, the better. The contribution room varies year by year, but it's between like, you know, somewhere between 4,000 to 8,000 every year, and it's cumulative. So let's say you haven't contributed up until today, you're gonna have quite a bit of contribution room that you can put in. And the earlier you can do it, the better, because it compounds over time, and that compound interest you will not be taxed on. Now, the one thing to note about the TFSA is that the income that you put in or that you take out from your corp and put like from your personal account, all that stuff, it is not tax deductible. Total opposite of the RRSP that we're gonna get into now. So the Registered Retirement Savings Plan, better known as the RRSP, similar account is the 401k in the US, is basically the opposite principle of the TFSA. So the money you put in into the RRSP is tax deductible on the total net income that you're going to be taxed. So it's a similar principle as to deducting the taxes of the total income that's taxable in the corp. Similar principle to a while ago. I'm not going to go deep dive into it, but basically you're deducting your total taxable income. The difference is that the RSP, the gains that you make, so when you invest into the RSP with the income that you put in, the gains that you make are taxable at that 50% rate, just like a normal personal investment account. The whole point of this, especially for doctors where it's important, is because the RSP, like when you're a physician, you're making quite a bit of income, right? And then when you put this money in the RSP, you lower your whole taxable income. Because with the goal of it, why it's called the retirement savings plan, is because when you retire, you're not making all this, you know, mega income anymore. You're just going to be slowly taking money out of the RSP, and you're going to be in a much lower tax bracket when you're older. So you're delaying those taxes at a lower future rate. Okay, so it makes a lot of sense to put your money into the RSP when you're making a lot of income as a physician. One thing to note as to how much room or contribution room you can put into the RSP is basically 18% of your prior year's total income. Okay, so basically, let's say you made $100,000 the prior year on your personal tax return, you can put $18,000 into the RSP this year, and then you just kind of calculate it every year moving forward. That's the rules in Canada. I'm not sure what it is in the US, but it's probably something along the same lines. All right, let's dive into the last registered savings account here, which is the First Home Savings Account, or the FHSA in Canada here. Now, this one is a phenomenal account. Honestly, I think it's the most advantageous account out of all of them. I think anybody who wants to buy a home for the first time should definitely contribute to this account. The contribution limit is $8,000 per year for a total of 5 years, with a maximum limit that you can put in is $40,000. And if you're gonna put money into this account, you have to have the intention of buying your first home in the next 5 years or so. So you have to have that intention, or else you can't go ahead and put the money in this account. If you do, you will be penalized in the future if you don't buy a home. Now, why is this account so great? Well, it basically has both the features of the TFSA and the RRSP. So it's tax deductible like the RRSP, and you also save on the passive income that you make. You are tax-free on the passive income that you make from this account here. So this is such a great account that irrespective of the stock market, irrespective of your line of credit rates, anything like that, we've crunched the numbers here, me and my buddy Omar, and basically it's a no-brainer to put money into the FHSA. Even after crunching the numbers, even as a med student, when you have a line of credit, to take out that line of credit money, the $8,000, and put it each year has shown, according to our calculations, to actually be more advantageous. So it's that good of an account to put the money into. Now, some people are more risk averse. They're not gonna do it. I get the line of credit thing. Not everybody wants to do that. But overall, as you graduate, as you've paid off most of your debts and all that stuff, it's a no-brainer if you wanna buy a home to put money into the FHSA because of its tax advantages. All right, that covers investing, all the main principles. I know there was a lot of details here. Definitely, circle back to the main things that you want to go over, but keep those main principles in mind. It will pay off in dividends in the future. All right, next big topic I want to cover here is insurance. That's the third big bucket here that we're going to cover. We covered the big first two, but this one's another big one that's actually quite important for medical providers especially. The biggest thing I want to get across when it comes to insurance is to be skeptical do your research. Do not just take the provider's word for it, okay? Because these people are inherently biased, so make sure you do your research, you talk to your friends, you talk to your colleagues, you talk to other attendings, you ask them about different policies, you make sure you do all your research when it comes to this. Watch videos like this that can give you more information. Definitely don't just sign up with the first provider that sells you a good story and stuff. They are biased, and you wanna make sure you have an airtight agreement with them, with the best provider possible, before you go ahead and move forward with an insurance company. When it comes to the two main types of insurance that I recommend for healthcare providers are, one, disability, and second, life insurance. Disability, in my mind, is a must for healthcare providers, and then life insurance, not a must, but can be tax advantageous, and we're gonna dive into that in a sec. All right, when it comes to disability insurance, the biggest thing, the biggest clause you need to have in your contract is an own occupation rider disability clause. That needs to be in there. What this clause means is that for whatever reason, if you have a disability and you can't practice a specialty that you were supposed to practice in, at that point, you're still gonna get payouts even if you start working in another job that pays significantly less. So let's say you go into admin or something like that and you get paid way less than you would as a neurosurgeon, for example. Well, the insurance is still gonna pay you the salary or the benefits you would have had as a neurosurgeon, okay? Or close to it anyways. If you don't have this clause in there, if you start working another job where you get compensated less, the disability payments won't come in anymore. So it really protects you. Without this clause, you could get royally screwed. So make sure that you keep this clause in there whenever you're negotiating with the insurance companies. And the second big thing with disability insurance is every year, sometimes they try and negotiate special offers, they try and negotiate the terms, all that stuff. Try and avoid this. If you're happy with the terms that you have on there, try not to, get too fancy and negotiate terms. And if you are going to go negotiate terms and put special offers in there, whatever it is, make sure you run it by a lawyer, make sure the contract's airtight and that it favors you. The second big one, like we mentioned a while ago, is life insurance. And like we mentioned a while ago too, it's not absolutely necessary, but it can be nice if you have a lot of extra cash in the corp for tax reasons that we're going to get into now. So for insurance, there's three big tax advantages. The first one is that they are tax deductible within your corp. So that's quite nice. It's considered as a business expense in a way. The second big thing is that insurance payouts, if ever you do get disability or life insurance, hopefully not, but let's say you get payouts from them, they are withdrawn tax-free on your personal side. They're not going to be on your taxable income. They're totally tax-free. It's all the money that you keep as a person. And the third big one too is some insurance policies, especially on the life insurance side, part of the money that you put in is going to build an asset over time that you can pay yourself out with time through your corp to personal, tax-free as well. One quick thing I want to mention about timing before we move on. The timing of insurance policies and their offers and all that stuff, it usually changes in Canada at least around October of every year. So that's something to keep in mind. And the biggest thing is as med students, we get a discounted rate for insurance. So in Med 4, before you become a resident, it's actually quite advantageous to start your insurance policy right around that timing. All right, so fourth big bucket here, it's the one that probably most of you are gonna wanna hear about, and that is billing. So how are you gonna actually make your money? Now, one caveat I wanna tell you guys is that it's the one process in this video that I haven't gone through myself. So definitely take my opinion with a grain of salt, but I will tell you that as I've gone through clerkship, as I've done deep dives on this topic on YouTube with the different resources I'm gonna share with you, I've actually learned quite a bit about billing. I'm no expert in it by any means because I haven't truly done it myself, but I think I can share some resources and tips with you that are actually gonna help you in your future practice. So resources, the best ones that I've come across. The first big one that I've learned a lot from is actually the YouTube channel Breaking Back Debt. It's basically a channel where it's Dr. Stephanie Zhao from U of T that covers everything that she learned on the personal finance side, on the corp finance side. She's a physician that's basically learned a bunch of stuff through trial and error, and she shares it on her YouTube channel for free. I've gotten a lot of good feedback here and a great deal of knowledge from this. So I definitely recommend this. She actually has a whole playlist on billing too that I would check out, link in the description below. The second biggest resource is, I'm gonna say, in residency, your staff that supersedes you, okay? That's one big one. And then when you're an attending, your co-staff, right? The people that you work with, they bill on a daily basis. So definitely ask them for tips and advice. And we're gonna go into that a little bit later here in this section. Another good resource is a Facebook group called the First 5 Years of Family Practice Facebook group. It's more tailored towards family physicians, but it's a great resource for family physicians that have questions about billing. And when it comes to the software that you use for your billing, honestly, I did a deep dive on this. There's no easy answer. There's a lot of options out there. No clear answer online from opinions that I could get. But what I would do is I would talk talk to your staff. Again, tying back to one of the first points here, talk to your staff, test it out yourself, especially in residency. Try and test out different EMRs, different billing systems, see what you like best, and then kind of move forward from there. I put a link in the description below with a blog that kind of talks about the top 30 ones to use in Canada. It's a place to start, but it's not a definitive opinion. I would definitely just, as you go throughout residency, as you become an attending, just test out a bunch of different ones and go with the one that you like best. So let's start diving into some principles here. So first we're gonna start with residency, then we're gonna go as an attending. So in residency, the biggest thing is that you start learning when it comes to billing. Some people delay, and they don't do it until they're an attending, and then it becomes very chaotic to try and learn as an attending. There's a lot of things you can learn throughout residency to make your transition a lot easier. And quick shout out, a lot of these tips come from the Breaking Bad Debt YouTube channel when it comes to the playlist of billing, so that's where I got a lot of these tips from. First big tip is when you're writing your notes, ask your preceptors if there's anything that you can adjust for billing purposes. Usually they're gonna actually tell you this and this because they're incentivized to do so, right? They're gonna give you different things to add, and then you're gonna kind of take away from there as you do this more and more. Okay, these are the things that they do. These are the little tricks they can do to make more money. Second big tip, get in the habit of putting timestamps and billing codes at the bottom of your notes for two reasons. One, your preceptors are gonna love you if you do this. And secondly, you're gonna learn, okay, which billing codes are used in what instances. And it's gonna be good practice for you to learn, okay, which billing codes are actually useful here. Third, save the high yield billing codes in a master document, okay? All you need is probably like a 2 or 3 page master document of all the useful billing codes for your specific specialty, and then the ones that come up over and over and over again. And then yes, with time, you're gonna learn which ones to put like off the top of your head, but this whole exercise is gonna help you, oh yeah, I forgot about this billing code. Oh yeah, this one's gonna be useful in this scenario. It's just gonna be an easy reference to kind of go to as you're writing your notes. Fourth, start building templates to increase your efficiency when you're seeing patients. So instead of just rewriting the note over and over and over again, build templates that you can copy paste from and then just fill in the important info from there. One, is going to improve your efficiency in residency, but then when you're an attending, it's going to improve your efficiency that much more, so you can see more patients and bill more basically. And then last tip here is to potentially take a billing course in your specific specialty. Not every specialty is going to benefit from this, but a specialty like family medicine, you know, there's a lot of different things that you can bill. Sometimes taking a billing course could be very useful. I haven't taken any yet, so I can't give any recommendations, but I've heard of people that have taken some and it's helped them tremendously. That being said, I would say the resource Breaking Bad Debt, that YouTube channel, definitely covers a lot on this topic. All right, now let's cover the tips as an attending here. So the first big thing that I actually learned from the Breaking Bad Debt YouTube channel, it takes quite a bit of time to get your billing number. So as soon as you become an attending, okay, as soon as you get that notification that you're an attending, you have your number and all that stuff, apply for your billing number because it takes a couple months to get in. So you want to start billing as soon as you can. You have to apply for that number as soon as you possibly can. Second big thing is rural settings typically pay premiums. You know, they typically pay a lot of money for you to go and travel to the rural settings. So a lot of doctors that I've talked to, they do this and they get quite a few premiums by going to those rural settings. So if that's something that interests you, if you want to practice rurally, something to keep in mind. So the third big thing for attendings is a hospital versus clinic setting. Something to keep in mind is that hospitals actually pay you to be there as attendings, whereas clinics, they charge overhead to be there. Now, there's definitely ways to make clinics work. It doesn't mean that clinics are bad and you don't make any money doing it, but just know that they do charge overhead, whereas hospitals try and incentivize you to be there. Another big thing that I found out is that hospital EMRs don't have billing systems integrated into them. So you have to kind of do things separately in the hospital. So don't get fooled. Don't go work in a hospital and then you realize that you didn't bill anything because you thought it was integrated with the EMR. It's not in Canada, so it's something to keep in mind if you're working in Canada. And the last big tip here for attendings is to maximize efficiency. There's several ways to do this. One, tying back to the point earlier, is to utilize those templates that you saved in residency to write your notes quicker and to see more patients. In the clinic setting, if you have this option to you, is to go see patients in multiple rooms and not having a patient come into your office and leaving from your office, where you can just go from a centralized computer in a centralized space in your office, let's say, and then just go room to room to room. A lot of studies have showed a much higher rate of efficiency if you do it this way versus if you just stay in one room and patients come and see you. And the last tip for efficiency here is to utilize residents and med students. Now, there is a caveat. If you have some that are a bit subpar, it might take you more time that it's going to save you. But if you actually take the time to train them well, to write things the way that you want them to and all that stuff, and you get to know them over time and you have that luxury, you know, you're almost deploying a little army of residents and students to go see the patients, just maximize efficiency and all that stuff, and it can save you a lot of time and you can see a lot more patients that way. Fifth big bucket, and I promise we're almost done here, and that is budgeting. So when it comes to budgeting, I like to keep things simple. I don't like to overcomplicate it. I like to just track things and make sure that I kind of follow a general principle, general framework whenever I'm budgeting. At the end of the day, you just want to spend much less than what you make, right? I think that's the true way to build wealth, but I don't think you can save your way to wealth. I think it's just you have to be smart with your expenses that you spend on. The framework I like to follow is roughly 50%, if not less, but hopefully no more than 50% on my living expenses, such as rent, car, all that stuff that I need to survive. And then 30% goes to like investing and learning. That goes back to like skill acquisition, knowledge, and all that stuff. I lump that all in the same bucket. And then 15 to 20% I like to put as fun, or miscellaneous things and all that stuff, emergency fund, all that stuff. But I like to put in that category where I'm actually like spending, not, saving too much and all that stuff. I've gotten burned with that in the past. I think it's good to spend on experiences and have fun and all that stuff. But if you follow this 50, 30, 20% framework or something close to it, it's a good principle to kind of keep in mind as you move forward with your budgeting. Great advice that I've gotten in the past about budgeting is to, once you become an attending, to live like a resident for like 2 to 3 years. The reason being is that your income drastically, skyrockets, but it's easily to succumb to lifestyle inflation, to start spending more, right? When you're an attending and you got a lot more income. If you live like a resident for those years, you can build kind of a nice big nest egg, invest properly, pay off your debts, all that stuff. And then from there, you start investing in the finer things in life, But if you really live like a resident for a good amount of time, as long as you can, at least when you're first in attending, you will build yourself a nice nest egg and be more financially free moving forward. There are a lot of tracking apps out there. I've used Mint in the past. I don't use it anymore, but I found it pretty useful. Maybe I'll get it more in the future when I start making more consistent income and when I want to really track my expenses. But overall, it's good for seeing how much income that you're making, how much you're bringing in, how much you're spending on, and it's really good at checking out all those little subscriptions that are just eating away at your money. Mint was good in Canada. There's a bunch of other apps that you could use out there, but I would say tracking is pretty useful, especially if you're more prone towards spending. The last big bucket here, the sixth item I want to cover, is banking. Now, for you physicians out there, med students, banks will basically cater to you because you're going to be high income earners and you're going to make the banks a lot of money one day. So they will cater to you a lot. I would say go with the bank you feel most comfortable with. Pro tip, if you find a good private banker that could really save you a lot of time, a lot of money, they can deal with a lot of the credit card stuff, a lot of the banking stuff that you don't want to hop on the phone with a customer representative for like 2 hours, right? They'll save you a lot of money. They do cost a fee. Usually it's like something around $100 a month. That's what I pay. Honestly, totally worth the money. And when you're an attending and you have a business, tax deductible. So totally worth it in that sense because it saves you a lot of time. As for which bank to pick, for Canadians, pretty much any big bank in Canada, they're backed by the government. The chances of them going under is very, very low. In the US, it depends. Like some banks have gone under in the US. Usually big banks tend to do pretty well, the really big ones at least. But again, in the US too, they're backed by the government. So the chances of you losing all your money are quite slim. That being said, really make sure you do your research and you pick the proper bank to go with. Last thing I want to mention on banks is utilizing credit cards. Now you have to be smart with it. If you don't control your spending and you don't pay off your credit card, one, it's going to affect your credit score quite poorly, but two, those interest rates are very high and they will accumulate quickly. So definitely don't do that. Be smart, pay off your credit card on time. Don't let those interest rates accumulate. Build good credit score that way. And thirdly too, with credit cards, you get to utilize credit card points where you can redeem those points for cash or for rewards like travel and all that stuff. So very high yield thing to do as you're, spending money and all that stuff. All right, my friends, that is a wrap for the video here. I know it was a long one. My voice is killing me by the end of this, but hopefully it was worth it for you guys and you got some value. To be honest, I hope I convinced you that taking charge of your finances is extremely important as a medical professional. It will end up saving you a ton of money down the road. There was a lot of info here. I encourage you to watch those specific sections that you didn't fully understand again and to seek out resources, ask questions, and be curious. Honestly, it's going to save you a ton of money in the long run and you're going to be happy you took this advice. So thank you so much for watching, guys. We will catch you on those future videos.